The best profits are those from which no tax is extracted. That's one of my favorite quotes. And that's what we're talking about today on the Sub2Deals Show. Hey, Sub2ers, welcome to this episode of the Sub2Deals Show, where we talk about all things subject to. And occasionally we'll talk about other real estate investing topics, but it's always something to help you with your real estate investing business. If you're listening to our podcast on Apple or Sketcher or Google or one of those other channels, we appreciate it and we'd love a 5-star review. But we're also going to ask you to head over to our YouTube channel at sub2tv.com. You can listen to the podcast there, look at our smiling faces, and watch some of the other videos that we release each and every week. We put out a video almost every single day, something to help you with your real estate investing business. That's sub2tv.com. If you're interested in learning more about creative finance, Sub2, seller financing, and all the stuff that goes along with that, visit us at sub2university.com. We've got coaching programs for every budget and programs that can help you learn how to create wealth and get rid of that job. And we also want to invite you, if you're just getting exposed to creative finance and you're not sure it's something that you want to do and you don't want to spend thousands of dollars on mentors, to join us at $7coaching.com. In that group, we will teach you and answer all your questions for $7 a month. That is the price of a latte at Starbucks, so you can't beat it. If you can find a more affordable coaching program anywhere, let me know about it because I want to join it. Guys, today we're talking about tax-free investing. What can you do to avoid all of the taxes that the government wants you to pay on all of your profits? And we brought in an expert today to talk to us about exactly how we do that. Mr. Walter Wofford from Jackson, Mississippi. Hey, Walter, how are you?
William, thank you. Thank you for inviting me.
Yeah, man, we're excited to have you here today. Gosh, Walter has been an investor for over 42 years down in Jackson, Mississippi, my home state. And he's just an expert on real estate investing in general, but particularly IRAs and how to avoid paying taxes. So he's going to share some information with us today on that. So tell us about yourself, Walter, how you got involved in investing and all about IRAs.
You know, I think it's in my blood, William. I went to Millsaps College here right down the road from where I am right now. And as a sophomore, I was out knocking on doors trying to buy a house and got some houses under contract. Right. And I didn't have anybody to tell me to do it or even to help me. Right. And it's funny that that house that I have in mind that I got on a contract for $32,000 fell out over a $300 item I didn't know how to negotiate. Mm-hmm. And it wasn't that many years later. It was about 8 years later. I moved on that block. And I paid $125,000 for the house I moved in, and that $32,000 house sold for $159,000.
Oh man, lost opportunities.
There's something here. There's something to this real estate business, and so I started where everybody else starts. You start as a landlord, most people do, and move. And a lot of people move to after they're landlording, they start doing wholesaling. And they get really good at that, and until they realize how many tax dollars they owe from getting good at that activity. Right. Then they start saying, well, where can I go to minimize what I do, minimize taxes? And that's really what we're talking about today.
Right. So I'm excited about that. I know when you're first getting started, you're just trying to get a deal, man. You don't worry too much about taxes, but after a while, you scrambled around all different ways you can to minimize them. But if you start really making money and being successful, it gets a little bit tougher. You gotta dig a little deeper to find some ways. So that's why we're excited to have you on here today.
Well, thank you, William. let me start with just a few basics that I'm not going to spend a lot of time on. I know you've got a sophisticated audience, and this talk is really for the person who's figured out how to generate investment income. Your subject to guys that's them, right? They figured that out. So let me share a couple of ways that you can minimize that activity. But let's go with the slides.
Okay.
Hit them?
Yeah.
All right. So there's my contact information at the bottom. So what I realized is tax-free money is about using inherited Roth IRAs if you're a youngster or under 59 and a half. And then we use Roth IRAs for the older than 59 and a half. And I'll show you why I say that. But let me just go ahead to the next slide, and I'll show you. I do want to make a recommendation. A friend of mine who you probably know, William, Quincy Long, just published this book.
Right.
And it's a good one, and you can get it on Amazon. It's an excellent book to talk about some of the things we're talking about today. If you needed to go read something, I'd say that's the one to get.
Right.
Very quickly, those accounts can be self-directed, even though the last two are not exactly IRAs. They are specialty accounts. So all the traditional IRA, Roth IRA, simple, and those are small business. SEP is a small business, and the 401k or the solo K. All those can be self-directed into investments that you know and understand. The education savings account is very powerful. And then, of course, health savings accounts can be self-directed too. And I think that's really important, the health savings account. You need to get them open before you turn 65. Very important, but that's not what we're going to talk about today. But those, I'm just identifying them for you. All right, so here's a little quiz for you, William. Let's see if you had $100,000 of just money, which of these do you think is the most valuable to use? If you got, and we're going to ask these questions, like, can you defer the tax on earnings if you got money invested? The answer is no. Typically, you can't, right?
Right.
Traditional IRA or 401k, you can defer them until some point in the future. When you start taking them out, they're going to be taxable. So the gains are deferred, but when you take them out, you're going to pay taxes as ordinary income.
Right.
Okay. The Roth IRA is not that way. So the Roth IRA, if you wait until you're 59 and a half and the account has been open for 5 years, or any one Roth account that you have has been open for 5 years, then you don't pay any taxes if you wait till 59 and a half. Okay.
Right.
The HSA, you can take the money out as long as you spend it on medical bills. And in the last 2 years, William, I've racked up $750,000 of medical bills, and I wasn't even trying. 19 days with COVID, and then a gallbladder surgery that took a week, totaled $750,000. Luckily, Medicare was there for me, and I didn't have to use that health savings account. But that's what it's there for. So if you got health issues, it's very important because there's no tax on that money. Right? There's no tax on the Roth money if you wait till you're 59 and a half. And then your education savings account, that would be the same thing that you're going to spend the money on education for, your kids and grandkids. Now, what's different about that, Congress made these rules up many years ago. So this may be new to your audience, but it's certainly not new. The Roths came out in 98. And so these rules have been out there. They had to figure out what to do with a account when somebody dies. And so an inherited Roth IRA is very similar to a Roth IRA in terms of the distribution rules. It's got to be open for at least 5 years, but that age limitation of 59 and a half goes away. So if you were able to orchestrate arranging, let's just say you've got a grandmother that's going to be passing soon, and she had some earned income or had a traditional IRA that she could convert to a Roth and put your name as a beneficiary on there, then under the new rules, when you inherit that at your age, under whatever age that is, it could be 3 years old, 5 years old, 20 years old. And this is why this is important. You don't have to wait until you're 59 and a half to take it out if you inherit a Roth IRA. All right, so I'm going to stop. You got any questions at that point?
I actually do now. So I understand that you don't have to wait until you're 59 and a half. So if my grandmother passes and she leaves me her Roth IRA, and I don't know, it doesn't matter what it's got in it, but she leaves it to me, and I can still do business in that Roth and still pull the money out right away tax-free?
If her account has been established for 5 years or more,
Right.
Let me challenge you on what you said, business. You can own a business, but what these accounts really for are for investments, not business.
Right. But I guess what I'm saying is and we've talked at length about buying deals Sub2 and Roth IRAs, and we should typically try to turn those in about 3 years, and we'll generate, $50,000, $60,000 profit. But what you're saying, if I understand correctly, what you're saying is I could do one of those deals inside that IRA and then take that money out that I've
and spend it
tax-free. So I never have to pay another dime in taxes.
That's what Congress created many years ago.
I imagine that. Okay.
Now the rules changed rather recently. So when you inherit one of these accounts, you got to fully deplete them in 10 years.
Okay. I see. So after 10 years, they're no good, basically.
Go get you another one.
Right. I understand. Okay.
All right. So to me, that's the Maserati. These inherited IRAs are. So let me show you a little bit more detail about this. So, you get a deduction for the traditional IRA contributions. You don't get a tax deduction for Roth IRA, and you don't ever make a contribution to an inherited Roth even after you receive them, because it's somebody else's account that you received when they passed away. All right, so the investment growth on all three of those are tax deferred, but so it's taxable for the traditional. You see that red, and I think they moved that to 72.5 or 3 recently. But if a Roth is not taxable if you're 59.5 and the account's been open for 5 years, there's no required minimum distributions on the Roth. And for the inherited Roth, you've got, after the original account owner had their account open for 5 years, then you got 10 years to deplete it after you inherit it. Now, I want to just point out a couple of exemptions to this 10-year rule. If you fit one of these categories in the bottom right box, then you fall under the old rules, which gives you more than 10 years based on your age to take it out. All right, so number one, surviving spouse. So your spouse can take it and add it to hers. No problem. A person who is not more than 10 years younger than the plan participant. That is the account owner who passed away. And I had one recently where I had an acquaintance who was 74, and I had my name on her IRA account, and I was 67 at the time. So you can see I wasn't more than 10 years younger. So I inherited that, and I actually had 22 years based on that single life expectancy table, based on my age at the time. Right. Now, if you're a minor child of the plan participant, that's the account owner, then they got certain rules about that. And then if you're a disabled person or chronically ill, then you fall under the old rules, which means think about if you've got a medically disabled child, this is a perfect vehicle, because you end up with a tax-free account for your life. Right. Okay. Let's move on a little quickly. So just to recap, the inherited Roth is best if you're under 59.5. The Roth IRA is better after that. So you can see the difference would be that you can take this tax-free EAT money out earlier than 59.5. You got any questions about that?
No, I'll tell you, when you're new to it, it's a lot to take in. They make these rules as complicated as possible. You correct me if I'm wrong here, but they do that so if you slip up, they can invalidate your IRA.
Well, I'm not sure that's the reason they did it, but you're certainly correct. You're certainly correct. All right, so let's just do a quick case study, and so you know that house. You've seen that house many times, haven't you?
Oh, for sure. That's a Mississippi house.
Mississippi house. $800 rental, 3-2. It's rented. It can be bought with 5 down, subject to a $30,000 remaining balance on an original $50,000 loan. So we got 12 years left,
right?
And the PITI is 500.
Mm-hmm.
All right, would you buy that deal?
Oh, sure. I bought hundreds of them.
Okay, so there's nothing special about that deal. That's the point I'm trying to make.
Right.
But let's consider if you rented it. And we're not talking about with just the way you normally do it, not in your IRA. Mm-hmm. But if you rented it, what kind of taxable event would you have? Let's do a little quick math. Mm-hmm. So we know, and let's just assume that you're making $300 profit per month.
Right.
But, you're making those mortgage payments and you don't get a deduction for the principal reduction. Mm-hmm. So you have some phantom income in there. And so that would be at least another $100 a month, maybe more than that. So if you add that $100 a month to the $300, your taxable income would be $4,800 a year, mm-hmm. Right?
Right.
All right. So $4,800 if you just rented it. And again, this is without considerations, without using an IRA. If you wholesaled it, and you've done that many times too, hadn't you?
Right.
Bought a Sub2, and you got 5 in it, and you get your 5 back plus mm-hmm. another 5. Now, what kind of taxable event is that?
Oh, that's the highest tax stuff there.
Well, it's business. It's not. If you do a bunch of them, you got to pay self-employment tax on them.
Right.
So you're looking at somewhere close to 50%.
Mm-hmm.
Arkansas has state tax, don't they?
Oh, yeah.
We've got there's a bill in our going through our government right now to do away with the taxes in Mississippi, and I think they're going to hit it this year.
Oh, state tax? That's great.
We're trying to compete with Florida and Texas.
Mm-hmm.
It seems like to me it'd be very easy to figure out how to eliminate the state tax. Something else has got to go up, and state tax. I mean, just offset it with something.
Mm-hmm.
Just think about all the people and the time and the accounting and all that stuff that goes away. Mm-hmm. Anyway, that's a rabbit hole. Mm-hmm. All right. So if you retailed it for 50 cash and you got a 35 basis in it,
mm-hmm.
what kind of taxable event is that?
Oh, yeah.
All right. That's that would be a short-term
capital gains. Yep.
And so if you do that as a business doing multiple times during the year, then you're back at the 50% taxation. Mm-hmm. Now, if you retailed it for 60 with financing, a lot of people don't realize that that's a fully taxable event too, mm-hmm. Right?
Right. It can be. Yeah.
It can be. Installment sale would take away some of that.
Right.
But that's what I know you have been preaching this for years, but you got to have your eye on the tax consideration. And mm-hmm. You got to.
Right.
And so let's just look. So I just want to show you that, with all of these, you're going to give up a big chunk in taxes.
Right.
Right.
Yeah.
All right. So let's go to the next slide. So in your typical deal, William, what entity would you use to buy that property?
We take title in a trust with an LLC being the beneficiary of the trust.
All right. So the taxable entity is the LLC.
Correct.
And so explain why you do that.
Well, to be honest with you, we do it for the liability considerations. That's the primary reason that we do it. I'm not the smartest tax person in the world, obviously. That's why I'm talking to you.
I think you're right. It's an excellent way to do it. And that's the way I do it too.
Mm-hmm.
But so the point I want to make to you is if you're buying with an entity
mm-hmm.
that ultimately you own that LLC. Is that correct?
Right. That's correct.
Well, why not just put your IRA in there?
Well, I mean, that sounds like what we're talking about here today, the smartest way to do it and get out of having any of this income taxed.
Now, if you're buying a debt financed property with an entity that's owned by your IRA, there could be some other tax considerations. I just want to bracket that, but the point I'm trying to make. It's exactly what you're doing.
Right.
There is not any difference except who owns that entity. And so you could do it. You could do it as just like what you said, buy it in a land trust. I guess that's the type trust you're using.
Right.
And then you would have, if you have a Quest IRA, Roth IRA account, that would be the beneficiary of your trust. You could put in more layers in there if you wanted to, but and so the income would go back to your custodian.
Right.
Right?
Correct.
All right. So now let's look at a few more taxability considerations. So I don't know how old you are, William, but let's just say you're 50 years old. Am I close?
I wish. I'll be 61 in May.
Okay. Well, you're still a youngster in my world. It says gray hair. My wife and I are both 68. We've been married 46 years.
So congrats. Yeah.
I kid her all the time. I say, we got married a month after graduating from Millsaps College here. And I told her, I'm your last chance. You better marry me now. She wasn't real swift back then. All right. So assuming you're 50 years old, what would be the taxable event if your acquiring entity was owned by your Roth?
Zero.
Zero, because you can't take it out.
Right.
And that's the point I wanted to make. So assuming you're 50 years old, what would the taxable event be if your acquiring entity was owned by your seasoned inherited Roth IRA, meaning the prior owner had that account open for more than 5 years?
Well, it would still be zero, but you could get to the money if you wanted to.
You get to the eat money, the tax-free eat money.
That's
Isn't that what we want? I mean,
you bet. For sure.
But it's the only vehicle that I know of that allows you to do that. And Congress created it. They know all about it. They've been using this for years in Congress. Oops. That's not what I need right there. Why don't I cut that phone off? Wouldn't that be a great idea? Okay. So that's the point I wanted to make. All right. So I got one more, and this is a real case study for me. I bought this house about 6 years ago for $50, and sold it this year for $148. The market just improved. I had been renting it for $1,500 most of the time that I owned it.
Right.
And so, any way you cut it, that's $100,000 gain.
Right.
All right. So I needed to listen to some of my videos. That's what I needed to do. So how much taxable income did I create? It wasn't in an IRA.
Right.
So that's long-term capital gain. So let's just call it 30%.
Right.
So I gave up, or will give up next tax year when I pay it, $30,000 unnecessarily. Because I bought it using a trust.
Right.
And so my taxable entity was a beneficiary. I could have just as easily, because I borrowed 50. I bought it for 50 and I borrowed 50. So I didn't have any money out anyway.
Right.
So if I had only done what I should have listened to myself to do, that's a $30,000 savings on one deal. one deal.
Exactly.
How many of your students do one a month? A bunch.
Oh, yeah, a bunch.
And so using this IRA as the bucket,
Mm-hmm.
if it's a Roth, you got to wait till you're 59 and a half, which you've met it and I've met it, and you could take it out tax free. But before that, now remember, if you're younger than that, you can still get to the EAT money. And that's the sweetest money there is.
Oh yeah, for sure. So let me just clarify something here. You bought this house for 50,000. So if you had done this deal in your IRA, you would have paid for it with IRA money, 50,000 out of your IRA.
No, because I borrowed it.
Okay, so
I borrowed it at closing.
Right. Okay, so your IRA, now my understanding was, maybe I'm wrong on this, is that your IRA can't be responsible for debt.
No, it can't be. It can borrow money certainly, but it can't be recourse to my.
Okay, it has to be non-recourse debt.
Yeah, and so just using your trust that you use, the trustee's not in any way personally liable,
right?
And the beneficiary is in no way personally liable. So just if you use your land trust, it is a non-recourse loan.
Okay. Okay. So you can still do this with your IRA, buying it in a trust. And if you're borrowing the money from a private lender or someone like that, they understand what's happening here. They would be okay with making that loan. If you were borrowing the money from a bank, this wouldn't fly that way.
Well, the banks like to get personal recourse.
Right.
And they want to be able to get their hands around your neck.
And they generally will not lend to a trust, in my experience.
My experience too.
Right.
But there are two national banks out there that are set up just to make loans for IRA purchases.
Oh, wow. Okay.
And so you just Google that, you'll find out who they are. But so that could have easily been a subject too if I had just negotiated to buy that for 50 subject to. Sure. Same thing.
Right. Okay.
So that's the end of that slide. I thought we'd go back and forth a little bit, but I wanted to let your audience see. Let me tell you what I did, William. I've helped a bunch of people talk to their families about how to leave an inherited Roth. And it's the reason I help families talk to other family members is this is what I have found, that the first time a family member asks you a question you can't answer, then the answer is no.
Correct. Sellers too.
That's exactly right.
Yeah.
So I said, I failed to do one thing, and that is to create everything you need to know about inherited Roth IRAs. But it took me 7 hours. Can you imagine that?
Yeah, that's a long talk. Yeah.
Well, that was over. What I did was did a 1 hour Zoom call every 2 weeks until I knocked it out. And I was supposed to be a 6-session recording, but when I finished the course, I realized, I said, oh crap, I didn't talk about distributions. How do you get the money out?
Right.
What is that process? And so we spent a whole bunch of time on distributions, because that's where you like it. You get to take those out.
Oh, that's the best part, isn't it?
Yeah. And so we created this in a community of about almost 100 people watch the videos. And so there, when you buy, if you do buy this for $297, you'll get immediate access to the videos. Number one. Number two, you'll get immediate access to the community of people who went through the training.
Right.
And that, that the community is everything. That's why you do what you do.
For sure. Yeah. I mean, all the experiences of everybody combined, it's just like a mastermind on the topic. Yeah. And
you can reach out through the platform that I have. You can talk to anybody in there and you know who they are. And what we found that it's a tremendous source of funding to have that group of people. So the best thing to do if you want to, on that shop, it'll be redirected to a shopping cart, that Sub2 tax-free Eat Money. Just type it into your browser. I don't think you can search by it because that's a relatively new link.
Right.
But just put it in your browser and it'll go to a shopping cart, and there's a 30-minute or so video talking about why you need to have an inherited Roth IRA. And for one good reason is to diversify your entities.
Right.
So all of my family members, my 3 grandchildren, all have inherited Roth IRAs. My sons, their wives, everybody has them. And what I think it's about a 40% advantage, a 40% lifetime advantage to have these accounts.
Right.
I'll tell you a deal that came across that I got to look at is somebody who had an inherited Roth IRA and they had some money in it, found a deal in Jackson where they had 2 houses, one across the street from each other. One of them had a tenant in it and the other one needed rehab. And so it was a $40,000 purchase for both of them. And what they did is, see, there is no tax accounting on IRAs. It's money out, money back in.
Right.
Money out, money back in. So interest, depreciation, none of that stuff really matters. It's dollars out, dollars back in. So how much did they have out going on that transaction? They had 40, didn't they?
Right.
And so they found somebody to buy the house that had the tenant in it for 40. So they got 40 back.
Right.
Then they fully renovated the other house across the street, and they spent $25,000 on that. So they bought 2 houses, sold one off, and then they sold it to one of the hedge funds for $97,500.
Right.
All right. So the difference between $97,500 and $25,000 is it's their non-taxable event. That money rolled back into their inherited Roth IRA, and they could take that money out immediately to go buy some margaritas or whatever they want to buy.
For sure.
That's a pretty interesting transaction, isn't
it is. Yes, it is. So I'm excited about this inherited thing. You know, I had never even heard of this until recently, until we moved to Arkansas, and I actually had lunch with Chip. You know, both of you know Chip, I know real well, and he was talking about it, and that's when he told me I needed to talk to you about those.
Well, it's nothing new. It may be new to you,
right?
And that's what I find out. It's a real. See, the thing about why people don't understand about these is because of all the money in retirement accounts, 97% are in traditional investments, stocks, bonds, money market, things like that. The 3% is in non-traditional. And so that's the area that I live my life is in the non-traditional.
Right.
In a lot of different reasons, a lot of different And you're the same way. You live in non-traditional. So if the strategies of taking what you know how to do and apply them to your retirement account assets, you can enhance your returns, can't you?
Oh, yeah.
Well, it's hard to do that with the stock market.
Yeah.
I mean, you can speculate, which every time I've speculated, it's cost me a whole bunch of money.
That's right. Yeah, I feel the same way. I've never been interested in the stock market. I felt like I had a lot more control over things with real estate. Because
you knew it's something you understood. Right. And so you can enhance it. So let me just, for those that don't know, there's only 2 things you cannot do with your IRAs. And that is invest in collectibles like Monet artwork or gemstones. And I think the reason for that is they're hard to evaluate.
Right.
And the other one, you can't invest in a life insurance product on somebody's life with your IRA funds. That'd be it would be against the best interests of the public, right?
Mm-hmm.
If you basically you go and you insure somebody with your IRA, and all of a sudden they get killed, and
yeah, that's a whole new course there, isn't it, Walter?
So
right.
It is. So, and then you got rules about who you can do business with and arm's length, and you can't be. We all want to do home cooking, but you can't do that. Meaning you can't borrow money from your wife's IRA, and there's other relationship prohibitions, but they're not really any investment type prohibitions. Now, let me tell you one thing that a lot of people they get hung up on. You can make $6,500 to $7,500 as a contribution for a traditional or a Roth annually.
Right.
And they say, how in the world can I grow that? And it's not the amount of money that you have in there. It's what you know how to do with that money.
Right.
And so even if you inherited a Roth IRA, even with a small amount of money, let's say it had $200 in there, William, what would you do with that?
Oh gosh, I don't know what we would do with $200. Share this with you. I used to know a guy back when I was in Macon, and he liked small mobile home parks, and he would find a small park that he liked and bring a private investor in to purchase the park, and then he would take his small amount of money that he had in his IRA and buy an option from this investor to purchase this park at a pre-established price in the future. Then he would go in, improve the park, put mobile homes in it, create notes, build the value by $200,000, $300,000, $400,000, $500,000 over the next 2 or 3 years, exercise his option, and the gain would all go in his Roth IRA. So he would take a small amount of money. That's what he did.
Well, and that's a good strategy. There's only one problem with that strategy is he can't be doing that improving.
Yeah. Well, I don't know if the rules have changed. Maybe that wouldn't necessarily be valid right now.
They do change all the time.
Right.
But in effect, what he would be doing is over contributing his personal services. So all that's fine if you just get somebody else to do it, not you. And that's a excellent way of doing it. So you could do that with even single family houses, couldn't you?
Right.
So that's about all I got today, William.
Okay. Well, I mean, so this program here will teach you everything you need to know about how to find inherited Roth IRA or how to get those and how to use them to invest and grow your business.
Okay. And your family is your best source of getting an inherited IRA.
Okay.
Now, they may not want to do that. And I'll tell you, my father-in-law was all game for it, except he didn't want, when he left this earth, which he did about 6 years ago, he didn't want my grandchildren to have a bigger share than the other grandchildren, because we were going to work his IRA that would be inherited. And he's right about that. That would have been a crisp environment when they're settling up that my grandkids had. So there are reasons why people don't want to do that. And I wasn't willing to take on all the other kids in the family, investing on their behalf. I didn't want to do that.
Right.
But so it doesn't work in every situation, but it doesn't take anything away from people. Right.
I got you. Okay. Well, everybody get over to Sub2, that's SUB, the number 2, taxfreemoney.com, and check out Walter's course. It's only $297. And I mean, man, sounds like a heck of an opportunity, $297 to learn how to grow your investment income tax-free forever. That's pretty amazing. So, Walter, we appreciate you coming today and sharing with us. And everybody, if y'all want to get in touch with Walter, you can learn more about it at legacyhacking.com. And you can contact Walter at walterwofford@gmail.com.
So, you got it.
Yeah. All right, man. We appreciate you being here today.
Let's do it again. Talk about another topic.
That's right. All right. Thanks, Walter.
Thank you.
Okay, guys, that is it for this episode of the Sub2Deals Show. We appreciate you being here with us today. And until we see you next time, get out there, talk to some sellers, buy some houses.